Hi everyone, this is Steve Elwell, Chief Investment Officer of Level Financial Advisors, and this is your fourth quarter 2025 market commentary. Another good quarter in the books. U.S. stock market gained 2.4% for the quarter. International stocks and emerging markets were the big winners, being up 5.2% and 4.73% individually. Global real estate slightly down for the quarter at negative 0.81%. And the bond market also had a good quarter, up 1.1% for the 3 months that ended the year. International stocks really were the story this year. It maybe didn't receive as much media attention as other news stories like tariffs and interest rate cuts and trade wars did. But international stocks really were the unsung hero of our portfolios for 2025, really across the board, whether you're talking about the Eurozone or Korea or basically anything that was outside of the U.S. really had a really nice year in total and a nice quarter to finish the year. Also, value stocks had a nice fourth quarter with a nice rebound with large and small value stocks that ended up outperforming growth nicely to end 2025. So good news on each of those fronts. Here's a nice visual from our friends over at Avantis Investors, really just sort of visually highlighting non-U.S. stocks versus U.S. stocks being represented by the S&P 500, which gained 17.9% for the year. So not a bad year by any measure, well above average, the long-term historical returns, average historical returns for any calendar year. But the MSCI ACWI Index ex-US, which is basically all the stocks outside of the US, returned a whopping 32.4% for 2025, which is actually the largest outperformance of international stocks versus U.S., the highest margin of outperformance in the past 15 years. And the next closest was in 2017, where international stocks outperformed by only 5%. So this year's outperformance, which is 14.5% for 2025, really is a pretty enormous outperformance. When you look at the difference between the two. And it's not really driven specifically by the developed international markets or emerging markets, both of which outperform the U.S. significantly. And there was kind of various factors that happened there. There was some fiscal stimulus in Europe that made a big difference, specifically from Germany. Another big factor was the decline in the U.S. dollar relative to other foreign currencies, which ends up making a big difference. But other parts of it was just simply that the price of international stocks went up more as a whole than the price of U.S. stocks, whether that's because increasing profit margins or future outlook or trade war related winners and losers. The end result really ends up being just a huge difference, almost double the return of the S&P 500 for stocks as a group outside of the U.S. So that was a really big story. It's a big story in the fourth quarter and a big story for actually the entire year. So speaking of the entire year, here's another nice visual from our friends at Avantis that kind of recaps some of the interesting information from 2025 market trends. So the first thing that really pops out to me on this chart is just how different the first, I'm going to call it 3.5 months were versus the remainder of the year. So you can kind of see on the bottom left part of this chart from January 1st to April 8th. Now April 8th was essentially the bottom of the tariff tantrum related decline that happened after the announcement of the tariffs in early April, which was essentially around April 4th. So through April 8th, the U.S. market was down 15% through April 8th. The drawdown from peak to bottom, because there was a bit of a positive territory that the market was in through the end of February. If you go from the peak to the trough, the decline was actually 18.7% for essentially what would be about 6-7 weeks. And that's a pretty painful and quick decline. And most of that decline actually really happened within about a week and a half in the first part of April. So part of what this is telling you, though, is just because there is some big, fast, quick decline doesn't necessarily mean that you should make a huge change in your portfolio or totally reconfigure your portfolio or sell and get out of the way until all of this has been sorted out. If you did that, you ended up making a pretty serious financial mistake. The worst day was April 4th, where there was a 6% decline. But the best day was April 9th, where it was a 9.5% rebound. Imagine if you had sold on April 8th and you missed April 9th. And many people seem to forget volatility bunches. And what I mean by volatility bunches is the big down days and the big up days tend to happen around the same time frame. They're bunched together. And you may say, well, why is that the case? Well, that's because the market is trying to digest new unexpected information. And these tariff announcements were a perfect example of that. The Wall Street predictions were much, much, much lower and much narrower than what ultimately was announced at the beginning of April. And the market, obviously being caught off guard, reacted in a hugely negative way. And then, if we remember right, one tweet changed everything when essentially the tariffs were mostly put on delay for a couple of months. And when that announcement came out, that's when the best day happened. So if you're out there trying to sell before any additional decline happens and then get back in when things look better, which on paper sounds like a great move, but in reality is nearly impossible for anyone to get right or get right consistently. I mean, think about what you have to do. You have to not only sell in advance of any additional decline or any starting decline if you're pessimistic before everyone else ends up being pessimistic. So you have to get the first part right, which is pretty darn hard to do. But then you also have to have the wherewithal to encourage, I guess I'd say, if you're so pessimistic, to decide when is it that I'm going to get back in, which to be successful has to be at a lower price than what you sold at. And psychologically, it is extremely unlikely that you're going to do both of those things and get them right. Because if you sell and the market continues to go down, first of all, you feel pretty validated that, oh, look how smart I am, right? I sold my stocks before the stock market continued to go down. But even at the first blip and indication that the market starts turning back upwards, it's very likely if you are already so pessimistic that you decided to make such a major change in your portfolio and sell all your stocks, it's very unlikely that your optimism is going to reappear magically as the market just slightly starts an increase. And that's not even what happened in this case. On April 9th, we got a piece of information from a tweet that postponed most of the tariffs for most of the countries for 90 days, and the market shot up 9.5%. So I hope you were on your phone or computer at the moment that came out, because if you didn't catch any start of the upswing. Almost the entire upswing basically happened in one day. And even then, yes, there was a little bit of a further decline, and then the full recovery took place by the time you got out until May. So maybe you had some time there, but things move fast. And so if you're trying to sell in advance of a decline and then buy at the bottom, I mean, good luck. because the statistics of even the world's best professional money managers tell us that that's basically impossible. And even if someone had the ability to do it, they would be wise to keep that information to themselves, because as soon as they let everybody else know whatever secret they've figured out, now it's probably not going to work anymore. Fortunately, though, once we got to the summer, the rest of the year, other than a bit of a decline that happened in the fall, brief decline in the fall, and a couple other even more brief declines, the market really kind of just marched its way all the way upward as corporate earnings looked really good and some of the tariff-related concerns started to dissipate. So a nice visual here from Avantis, like I said, of sort of what happened throughout this year. Then another visual here from our friends at JP Morgan that just kind of reiterates some of what I just talked about. So not only the diversification aspect of having stocks outside of the U.S. and having bonds and a whole mixture of different things, but also the frequency of receiving positive returns over a rolling period, and it shows the various periods. So the gray lines are represented by a 100% stock portfolio, and then the green lines are represented by a 60% stock, 40% bond portfolio. And you can start to see the difference after you get out into 1 year, 3 year, 5 years, that in the short term, the frequency of having positive returns over any one day is basically a coin flip. Over 1 week is about 60%. Over 1 month is about 66, 68% between the two. And then you start to see some of the deviation over 1, 3, 5, and 10 years. So the stock returns over that timeline is 82% positive for any 1 year rolling timeline. But for a 60-40 portfolio, it's 85%. Over 3 years, the gap widens, 85% for all stocks, 91% for 60-40 portfolio. 5 years is really, for me, probably the most notable portion of this chart. 87% of the rolling timeline. Now, this is also over the last 35 years, by the way. So it's rolling 5-year time frames all the way through those 35 years. So that's a lot of data. 87% of the time, if you had an all-stock portfolio, you made money. 99% of the time, a 60-40 portfolio made money. If you're someone approaching or already in retirement, that's an extremely useful piece of information and very helpful. So you can kind of digest part of the point of having diversification at that timeline when you're actually living off the money. And then over 10 years, the gap sort of shrinks a little bit more, although still notable. 93% of the time, stock market returns are positive over 10 years, all stock portfolio. But 100% of the time, a 60-40 portfolio is positive. So that kind of just lends some data and long-term information to just how important diversification may be, particularly if you're someone approaching or recently retired or deep into retirement and trying to live off the portfolio. The last thing that we're going to point out here is there was 3 interest rate cuts by the Federal Reserve Board. One in September for 1/4 point, another in October, and another in December, each for 1/4 point. So a cumulative drop in the federal funds rate of 0.75%, almost 1%, over the last 3 months of the year. That's part of the reason why the bond market did well, as those interest rate cuts showed up. So now the federal funds rate sits essentially at 3.5 to 3.75% is sort of their target range. This visual shows you the long-term federal funds rate. You can really see as it got into the back part of 2024 and 2025 how the cuts have taken place, which have been pretty aggressive. in response to inflation coming back down from the peak, which was essentially like 9% back in the summer of 2022, the Federal Reserve had to dramatically raise interest rates to fight inflation. And once the evidence started to become clear that the Fed was winning that battle, that they started to bring interest rates back down to a more reasonable level. And so this also has a bit of a projection about what the market and the Fed themselves think interest rates might look like next year, by the end of next year, and also what they might look like by in the long run. And essentially, the Fed is projecting about maybe another one interest rate cut at 0.25% next year, whereas the market thinks it might look more like 2. A lot will probably be determined by what happens if Powell leaves. The chair, Jerome Powell, leaves by May, which seems very likely considering the disagreements between himself and the president. But also then who's appointed, which we don't yet know who the preferred candidate is for that role. But I think we can all rest assured that the president's pick will be someone who is strongly in favor of cutting interest rates further. The president's made it pretty clear that that's what he wants. There is some real risk in doing that. If you hold interest rates too low for too long, then it's possible that the economy gets overheated. And most people at the first blush of that statement may say, is it really bad that the economy gets kind of hot and maybe jobs are plentiful and businesses are doing great and the economy's growing super fast? And at first blush, yeah, that sounds great. The problem is then you may have too few dollars chasing too many things, and then all of a sudden you get inflation. And we just had inflation. And I think it was pretty clear that people did not like it. So I think there's a real risk of saying what is the right level of interest rates for today's economy, knowing that the job market has been slowing, but the economy appears to still be doing fine, and corporate profits seem to be pretty good. Thus, stock market all-time highs. So what is the right level of interest rates? And that is hotly debated in today's scenario. Most professionals think somewhere around 3%. That's what the market expectations are essentially telling us here, while they're projecting 3.1% interest rates by the end of 2026. But there are other factors at play as well, beyond just the job market and inflation. Believe it or not, there are kind of some other pieces that probably will be influential. So there's a real balancing act there between inflation and jobs and interest rates. So that's the Federal Reserve Board's role, right? Is to digest all that information and to determine what is appropriate to help keep the economy on a sustainable growth path with full employment, but also low inflation. And that's a dual mandate that they have. They are required to pay attention to employment and inflation. And if one or the other gets out of line with what their targets are, then their job is to try and get it back in line. And previous 3-4 years, they've been focused mostly on inflation. And it appears that they kind of are winning that battle. They've got it down pretty dramatically, but not all the way where they want to get it. So we'll see how that balancing act plays out here over the course of the next year. But that has had, the cuts specifically in the last 3 months of 2025 had a positive effect on the bond market returns. And bonds, had a great year. I mean, bonds earned like 7% in the U.S. bond market last year, which is about above average year for what we have seen over the rolling 5-10 years, or even probably 15 or 20. So that's a good year on both sides of the portfolio. Good year for stocks, good year for bonds, great year for international and emerging market stocks. So we will see what 2026 holds. One final word of caution: you're going to read a million predictions in the Wall Street Journal and financial websites and on analysts on TV and the talking heads and pundits. And they're all going to have amazing predictions that sound really smart and have a lot of thought given to them. And I'm not discounting any of that, but what I can say is what will move stock market prices in 2026 is the same thing that always moves stock market prices, which is new information, new news, unexpected news, surprises, all the above. Those are the unknown is what will change stock market prices. So to think that you can predict that in advance is probably not a great idea because we all know that we can't predict the future. But I will say going into 2026, if you're looking at things like corporate profit margins, corporate earnings, expected and announced projected growth, the current state of the job market, the current state of inflation, I think you're starting from a reasonable place. Reasonable in terms of being relatively optimistic about stock market returns, cautiously optimistic about bond market returns. I think the ultimate Fed nominee for the new chair, once we receive that information, probably will have an impact a little bit on what happens in the fixed income markets. So we will all find out together. In 3 months from now, I'll fill you in on what's happened for the first quarter of 2026. But until then, I'm Steve Elwell for Level Financial Advisors. We'll talk to you soon.